2 weeks before Lehman Brothers filed the largest bankruptcy in American history, one of the most powerful financial institutions in the world looked at Lehman's books, examined its assets, reviewed its debt obligations, and issued an official verdict. Lehman Brothers was financially sound, investment grade, safe enough for pension funds, safe enough for retirement accounts, safe enough for the savings of ordinary people who trusted the system to tell them the truth. But that's not the crazy part. The crazy part is that the analysts who issued that rating knew, not suspected, not wondered, knew. Internal emails that were later subpoenaed by congressional investigators show analysts at the major rating agencies discussing, in plain language, the problems with the models they were using, the pressure they were under to maintain ratings that didn't reflect reality, and the fundamental conflict of interest that made honest analysis not just difficult, but financially dangerous for their employers. The crazy part is that this wasn't incompetence. Incompetence would be forgivable. What the documents revealed was something more deliberate and more disturbing. A system that had been carefully constructed over decades to ensure that the people paying for ratings would always get the ratings they needed. A system where the analysts who raised uncomfortable questions were managed out, passed over for promotion, or simply ignored. A system where the business model itself made honesty impossible. And the craziest part of all? After the financial crisis destroyed trillions in wealth, wiped out millions of retirement accounts, cost millions of people their homes and their jobs and their financial security, the rating agencies paid small fines, made minor adjustments to their procedures, and continued operating. The same three companies that failed to warn the world about the greatest financial crisis since the Great Depression still control approximately 95% of the global credit rating market today. They are still the official arbiters of financial safety for the entire global economy. By the end of this video, you are going to understand exactly how the rating agency system was designed to fail, why the failure was inevitable given the incentives involved, and why nothing fundamental has changed since the crisis that should have destroyed their credibility forever. This is the story of Moody's, Standard & Poor's, and Fitch, and the greatest regulatory failure of the 21st century. To understand how the rating agencies failed so completely, you need to understand what they are supposed to do and why their role in the global financial system is so critical. A credit rating is an opinion about the likelihood that a borrower will repay their debt. When a company or a government wants to borrow money by issuing bonds, investors need to assess the risk of lending that money. For large, sophisticated investors with teams of analysts, this assessment is possible. But for smaller investors, pension funds, insurance companies, municipal governments, the task of analyzing the creditworthiness of thousands of different borrowers is impossible without help. This is where rating agencies come in. They employ analysts who specialize in evaluating the financial health of borrowers. They assign ratings on a standardized scale, from AAA for the safest borrowers, down through various grades to D for borrowers who have already defaulted. These ratings are used by investors around the world to make decisions about where to put their money. They are also embedded in financial regulations, which require certain types of investors to hold only investment-grade securities, meaning bonds rated BBB or above. For most of the 20th century, this system worked reasonably well. Rating agencies were paid by investors who wanted independent analysis. Because their clients were the people who needed accurate information to make investment decisions, there was a strong incentive to get the ratings right. An agency that consistently issued inaccurate ratings would lose clients and revenue. Then in the 1970s, the business model changed. Rating agencies switched from the investor pays model to the issuer pays model. Instead of being paid by investors who wanted independent analysis, they began being paid by the companies and governments that were issuing the bonds and wanted ratings assigned. The conflict of interest this created was so obvious, so fundamental, so clearly dangerous that it was discussed openly in academic literature almost immediately after the switch. The problem is simple. If you are paid by the people who need good ratings, you have a financial incentive to give good ratings. If you give a company a low rating, they will take their business to a competitor who will give them a higher rating. If you consistently give lower ratings than your competitors, you will lose market share and revenue. The only sustainable competitive strategy in an issuer pays world is to give ratings that issuers want to receive. The senior tranches, which would be paid first if any loans defaulted, could theoretically achieve AAA ratings even if the underlying loans were relatively risky. The junior tranches would absorb the first losses and would receive lower ratings and higher interest rates to compensate. This was not inherently fraudulent. The mathematics, under certain assumptions, was sound. But those assumptions included one critical requirement: the loans in the pool had to be relatively uncorrelated. If thousands of mortgage borrowers across different states and different economic circumstances all defaulted at the same time, the diversification that made the senior tranches safe would disappear. The rating agencies knew this. Their analysts understood that the safety of CDO senior tranches depended entirely on the assumption that mortgage defaults would remain uncorrelated, which in turn depended on the assumption that housing prices would not fall simultaneously across the entire country. They built this assumption into their models, and then they refused to seriously examine whether the assumption was still valid as the housing market became increasingly overheated. Why? Because the fees from rating-structured products were extraordinary. A standard corporate bond rating might generate $10,000 to $50,000 in fees. A single complex CDO could generate fees of hundreds of thousands to millions of dollars. By 2006, structured finance ratings were generating the majority of revenue at all three major rating agencies. The business had become completely dependent on continuing to rate the products that Wall Street was creating. The pressure this created inside the rating agencies was intense and well documented. A 2008 congressional investigation uncovered emails from analysts that read like confessions. One Standard & Poor's analyst wrote that a deal could be structured by cows and they would rate it. Another wrote that the models did not capture half of the risk. Internal communications showed analysts being pressured by business development colleagues to maintain or upgrade ratings on deals where the analytical team had concerns. Analysts who pushed back found their deals reassigned to colleagues who were more accommodating. One particularly revealing sequence of emails showed an analyst raising concerns about the assumptions underlying a specific CDO rating. The response from a senior colleague was not to engage with the analytical concerns, but to note that if they did not rate the deal, a competitor would. The deal was rated. The concerns were not resolved. They were simply documented in an email chain that would later be subpoenaed by Congress. The mathematical models the agencies used were also deeply flawed in ways that were known or should have been known. The historical data on mortgage default correlation that was fed into the models came primarily from the 1990s and early 2000s, a period of rising housing prices and relatively conservative lending standards. The mortgage market of 2005 and 2006 was fundamentally different. Lending standards had collapsed. Subprime borrowers with no income verification, no down payment, and adjustable rate mortgages that would reset to unaffordable levels were being given loans. The correlation assumptions that had been valid in a normal market were completely invalid in a market where millions of underqualified borrowers had been given mortgages simultaneously. The agencies did not update their models to reflect the changed reality of the mortgage market. They could not, because updating the models would have required downgrading the securities that were generating their fee income. Instead, they maintained the mathematical fiction that the housing boom had created a generation of safe mortgage securities, right up until the moment the housing market collapsed and proved them catastrophically wrong. Lehman Brothers held billions of dollars in mortgage-related securities that the rating agencies had rated investment grade. When housing prices began falling in 2007, those securities began losing value, but the rating agencies were slow to downgrade them. Each downgrade of a security that had previously been rated AAA was an implicit admission that the original rating had been wrong, which raised uncomfortable questions about the agency's other ratings. So ratings were maintained longer than the underlying reality justified. When downgrades finally came, they came in massive waves, as the agencies tried to catch up with reality all at once. These waves of downgrades created cascading effects across the financial system. Institutions that were required to hold only investment-grade securities were suddenly forced to sell assets that had been downgraded. This forced selling drove prices down further, which triggered further downgrades, which triggered further forced selling. Lehman Brothers received its last investment-grade rating from all three major agencies in the days before it filed for bankruptcy on September 15, 2008. The ratings were not merely wrong. They were wrong in a way that caused direct harm, because investors who relied on the ratings continued holding Lehman exposure when they should have been reducing it. The aftermath of the financial crisis produced extensive investigations into rating agency failures. Congressional hearings, SEC investigations, and academic studies all reached similar conclusions. The issuer pays model had created conflicts of interest that made accurate rating of complex structured products impossible. The agencies had known their models were flawed. Internal pressure to maintain ratings had overridden analytical concerns. The regulatory system that embedded rating agency judgments into law had amplified the damage by forcing institutional investors to make decisions based on ratings that were known inside the agencies to be unreliable. The legal and regulatory response was deeply inadequate. The major rating agencies paid fines. Standard & Poor's paid $1.375 billion in a settlement with the Department of Justice in 2015. Moody's paid $864 million in a similar settlement in 2017. These were large numbers in absolute terms. They were modest relative to the damage caused and to the revenues generated during the years of ratings inflation. No rating agency executive was prosecuted for the failures. No analyst went to prison. The legal theory that protected the agencies was elegant and troubling. Rating agencies argued that their ratings were opinions protected by the First Amendment. Just as a newspaper could not be sued for publishing an opinion that turned out to be wrong, a rating agency could not be held liable for issuing a rating that turned out to be inaccurate. The courts largely accepted this argument. The regulatory reforms that followed the crisis were similarly incomplete. The Dodd-Frank Act of 2010 included provisions intended to reduce reliance on rating agency judgments and address conflicts of interest. But the issuer pays model, the fundamental source of the conflict, was not eliminated. Attempts to create alternative funding mechanisms for rating agencies foundered on the practical difficulty of designing a system that could replace the existing one while maintaining market function. The issuer pays model continues. Moody's stock price is higher today than it was in 2008. Standard & Poor's parent company, McGraw-Hill, later renamed S&P Global, has seen its market capitalization increase by more than 10 times since the crisis. The rating agencies did not just survive their greatest failure. They emerged from it more profitable and more dominant than before. The lesson that should have been learned from the 2008 financial crisis is that financial opinions cannot be trusted when the people issuing those opinions are paid by the people who need favorable opinions. This lesson was understood. It was analyzed. It was documented in hundreds of government reports and academic papers and journalistic investigations. And it was not acted upon because the political will to restructure a system that was deeply embedded in global financial markets and that was defended by one of the most powerful lobbying operations in Washington was not sufficient. Lehman Brothers received an investment-grade rating 2 weeks before it collapsed. The analysts who issued that rating were not stupid. They were not blind. They were operating in a system that had been carefully designed to produce exactly that outcome. A system where telling the truth was financially punishable, where raising concerns was a career risk, where the business model itself made honesty structurally impossible. That system is still operating, right now, rating the bonds in your pension fund, rating the securities in your insurance company's portfolio, rating the debt of the companies and governments whose financial health affects every aspect of your economic life. They gave Lehman Brothers an A 2 weeks before it was gone. If you believe the public deserves to know where the money actually goes, subscribe. Every week we cover the frauds, the scandals, and the financial crimes the system would rather you forget.